This study highlights the transformative potential of Bitcoin mining to convert waste gas from LFGTE projects into a valuable resource, signifying a departure from traditional, regulation-driven environmental mitigation strategies towards innovative, financially incentivized efforts. Hey y'all, for this week's read I have hot off the presses, an integrated landfill gas-to-energy and Bitcoin mining model by the following authors: Murray A. Rudd, Matthew Jones, Daniel Sechrest, Daniel Batten, and Dennis Porter. As Dennis Porter points out, this new research, co-authored by a former Greenpeace activist and environmental economist, confirms that Bitcoin mining is a powerful tool to clean up the environment and mitigate methane emissions. The paper shows that Bitcoin is good for the environment, Bitcoin can fund methane cleanup, Bitcoin converts waste to economic value, and if 1% of the Bitcoin network converts to vented methane, it would eliminate the emissions equivalent of 9 billion miles driven by a gas-powered vehicle. And now on to an integrated landfill gas-to-energy and Bitcoin mining model. Abstract. This study introduces a novel model assessing the integration of Bitcoin mining with a landfill gas-to-energy (LFGTE) project for methane mitigation. By utilizing a Monte Carlo simulation, we explore the economic viability of coupling Bitcoin mining's financial incentives with methane capture at landfill sites. Our findings reveal that lower electricity costs and Bitcoin hash price fluctuations significantly impact the financial outcomes of such integrations, underscoring the potential of Bitcoin mining to serve as a sustainable economic model for methane mitigation. The study demonstrates that modern, energy-efficient mining rigs can sustainably enhance profitability and act as a buffer against financial losses, highlighting the importance of technological advancements and efficient energy use in maximizing the integration's benefits. Furthermore, we estimate a 1.14 megawatt facility could mitigate 2,187 metric ton CH4, valued at $7.6 million, offering significant CO2e reductions from previously undeveloped landfills. The scalability of this approach suggests transformative possibilities for global methane mitigation initiatives, extending beyond landfills to sectors like agriculture, food processing, wastewater treatment, and energy. By providing a flexible framework for evaluating various scenarios, this research contributes to the broader discourse on sustainable energy and the Bitcoin network, proposing a novel, market-driven strategy to help mitigate methane emissions and improve environmental sustainability. Introduction. Growing methane emissions pose a significant challenge for climate change mitigation. Methane emissions, which have persistently risen since the early 2000s, are projected to continue their upward trajectory until 2050 unless sustainable international mitigation efforts are enacted. Methane, with a global warming potential of 27 to 30 times that of CO2, presents a significant and long-lasting challenge to climate mitigation efforts. Emission sources are multifaceted, encompassing both natural phenomenon and anthropogenic activities across sectors like agriculture, waste management, and energy. The immediate need for methane mitigation becomes more critical as delays escalate future mitigation complexity and costs, which are already projected to be 2 to 4 times higher than if addressed in the 2010s. Focused mitigation initiatives up to 2030 could yield a reduction in warming rates by more than 25%. Conversely, postponement could limit the impact to a mere 5% reduction. Recognizing the importance of methane mitigation, over 150 countries have endorsed the Global Methane Pledge. While a wide range of proposed methane mitigation strategies exist, no single approach can fully address anthropogenic emissions, necessitating multifaceted interventions across agriculture, waste management, and energy sectors, as well as behavioral change. However, concerns remain about the slow pace of mitigation implementation relative to global needs, with factors such as capital-intensive infrastructure, uncertain revenue streams, and regulatory environments impacting progress. Economic factors critically influence the pace of methane mitigation deployment. Financial levers such as tax credits for methane-derived biofuels have shown efficacy in various regions, and carbon credit programs are widely used. Yet, macroeconomic pressures like economic downturns and high interest rates present barriers to funding capital-intensive projects, with benefits accruing into the distant future, raising the question of alternative avenues for incentivizing methane mitigation. Converting waste methane into electricity for Bitcoin mining is a potentially scalable, novel solution for rapid deployment, offering an avenue for revenue generation and cost recovery that could accelerate landfill gas mitigation efforts by making it more profitable relative to, when available, other revenue streams. Bitcoin miners, sensitive to electricity costs, already often co-locate with renewable energy projects, suggesting potential to co-locate mining operations with industrial sources of methane emissions. The U.S. government has, in fact, acknowledged the prospects of utilizing stranded methane, quote, produced during natural gas drilling and transmission, and by oil wells, landfills, sewage treatment, and agricultural processes, unquote, for Bitcoin mining. Hoy et al. Emphasized the need for government subsidies for methane mitigation. The private sector often responds more swiftly to price incentives for climate mitigation efforts than public utilities. However, the success of government subsidization depends on policy implementation in diverse jurisdictions that vary in socioeconomic context and governance capacity. Conversely, Bitcoin's economic incentives are available globally, potentially encouraging mitigation without the need for government incentives. Central to our investigation is the economic and environmental viability of leveraging Bitcoin mining to support and enhance methane mitigation efforts at landfill sites. This inquiry explores whether Bitcoin mining can serve as a sustainable economic model, potentially making it an attractive option for mitigating methane emissions more broadly. Our model, employing a Monte Carlo simulation, establishes a flexible framework for evaluating integrated Bitcoin mining and LFGTE projects across a variety of scenarios. The underlying principles and findings have implications for wider applications, including orphaned oil and gas wells, wastewater treatment plants, farms, and agricultural processing operations. The versatility of our approach suggests potential for adaptation and scalability, offering insights into the broader utility of Bitcoin mining in addressing the global challenge of methane emissions. Our goal is not only to lay a foundation for understanding the specific potential of Bitcoin mining and landfill methane mitigation, but also to spark a broader consideration of how similar models could be applied across various sectors facing methane emission challenges. By examining the scalability and economic viability of Bitcoin mining as a mitigation strategy, this paper aims to contribute to the global endeavor to curtail methane emissions, offering a novel perspective on combining a disruptive new financial technology with renewable energy projects for environmental sustainability. Background: landfill-gas-to-energy. LFGTE projects play an important role in environmental stewardship by capturing methane and converting it into a renewable energy source. These projects not only mitigate the release of methane into the atmosphere, thereby significantly reducing greenhouse gas emissions and providing social benefits, but also contribute to the diversification of energy sources and reduction of harmful leachates and other harmful emissions of gases. The life cycle of converting landfill methane into energy encompasses several stages, beginning with the collection of LFG. A proportion of that mixture, depending on landfill age and other variables, is methane that would exacerbate global warming if not destroyed. Advanced processing transforms LFG into fuel suitable for generating electricity or thermal energy, or for further processing into automobile fuels or natural gas. In addition to direct electricity production, LFGTE projects offer the potential for harnessing low-grade waste heat for applications such as district heating, further enhancing the energy utility of the process. The economic landscape of these projects is influenced by local and regulatory contexts, which can enable access to various financial incentives like carbon credits. These incentives, alongside the revenue generated from the sale of biofuels and electricity, underscores the multifaceted benefits of LFGTE projects. Through these mechanisms, LFGTE projects embody a practical application of circular economy principles, transforming waste into diverse revenue streams while bolstering environmental and public health. Bitcoin mining. Bitcoin operates on a proof-of-work mechanism requiring approximately 0.63 zettahash per second as of April 2024. It consumes about 172 terawatt-hours of electricity annually, accounting for over 0.77% of global electricity consumption. This sustainable energy demand, while frequently criticized for environmental and socioeconomic reasons, underpins the Bitcoin network's security, deterring fraudulent activity by making the financial and physical energy costs of unauthorized alterations prohibitive. Bitcoin's proof-of-work validation thus has the financial power to strongly disincentivize fraudulent behavior and, instead, increase levels of trust needed for pseudonymous financial transactions. Miners generate blocks of financial transactions that constitute the backbone of Bitcoin's global ledger. Bitcoin mining utilizes application-specific integrated circuits, ASIC chips, specifically designed to deliver the intensive computational power required to compete for and solve SHA-256 cryptographic algorithms. Successfully solving these puzzles rewards miners with the right to create a new block and bestows both a block reward and all block transaction fees to the successful miner. Those earnings, paid in Bitcoin, can either be held speculatively or swapped to local currencies to cover operational costs. Bitcoin mining offers several unique advantages for LFGTE producers compared to traditional biofuel and electricity sales models, potentially making it a novel and compelling option for LFG utilization. These could be especially important in remote areas or in jurisdictions with limited capacity to finance long-term mitigation investments due to prohibitive upfront costs or high discount rates. 1. Global market access enables miners and landfill operators to tap into a worldwide customer base, overcoming regional limitations on energy or biofuel sales. 2. Dynamic scalability facilitates the flexible utilization of LFGTE-generated electricity, optimizing the use of intermittent energy production or market demand. 3. Cost savings can reduce or eliminate costs associated with grid connection and transmission losses for newly electrified sites. 4. Infrastructure independence. Bitcoin mining facilities can be set up at any site, irrespective of electricity grid connections or communications infrastructure. Venturing into Bitcoin mining introduces risks such as Bitcoin's price volatility and regulatory uncertainties. To mitigate these challenges, landfill operators can forge partnerships with seasoned miners, utilize financial instruments for hedging price risks, or adopt diverse business models from revenue sharing to power purchase agreements, PPAs. Such strategic considerations are crucial as shifts in regulation and public perception can impact the viability and perception of Bitcoin mining endeavors. The nodal power operation in Utah exemplifies the innovative integration of LFGTE projects with Bitcoin mining. Their 1.6 megawatt project transformed a site that actively flared landfill gas into one that utilizes methane to generate electricity for Bitcoin mining, showcasing a novel approach to resource utilization. Similarly, in New Mexico, Nodal acquired an operational grid-tied LFGTE facility and integrated a behind-the-meter data center. This operation allows for the strategic dispatch of electricity between the grid and the data center, optimizing the use of landfill gas. Such dual-purpose applications not only introduce new revenue streams, but may also enhance the electrical grid's resilience through miners' abilities to rapidly adjust to grid demand fluctuations. The infrastructure investment for converting a landfill site, already harvesting gas, into a Bitcoin mining power generation site is approximately $2.5 million per megawatt, predominantly for the generator and ASICs. LFGTE companies often prefer compensating landfill owners with royalties on gross revenue, encouraging optimal LFG flow management while adhering to legal regulations, thus maximizing electricity production. Given the Bitcoin network's fluctuating hash rate and price, the proposition of gross revenue can vary, making a royalty-based revenue sharing model beneficial for developers as a downside protection mechanism, while also offering landfill owners the potential for significant upside benefits. 3. Model development. Our study employs a Monte Carlo simulation model developed with Lumia Systems Analytica platform to offer insights into the integration of LFGTE projects and Bitcoin mining operations. This model facilitates the examination of complex, uncertain parameters influencing financial viability in the energy sector. We used a sample size of N of 10,000 draws and employing median Latin hypercube sampling for robust scenario analysis. Our aim was to capture a broad spectrum of high-level outcomes influenced by electricity production costs, mining rig choice, and Bitcoin market dynamics. Note that we did not use detailed landfill methane production modeling, but instead drew electricity generation cost samples from across a range of feasible options. Landfill assumptions. We constructed the model based on the assumption that 10 million kilowatt hours of electricity, or 1.14 megawatt, would be available for Bitcoin mining. This could be supplied by many low-flow facilities in the USA or by landfills with higher flow but which had other commitments for a portion of their electricity generation capacity. Working backward, this would imply a landfill producing roughly 7.8 million cubic meters per year LFG, 525 SCFM, from a population base of around 65,000 people, assuming 2.2 kilogram per person per year waste, 150 kilogram per cubic meter waste to LFG production, 85% collection efficiency, 50% methane content, energy content of 10 kilowatt hours per cubic meter LFG, 30% conversion electricity generation efficiency, and 0% electricity retained for landfill use. We recognize that our landfill assumptions are simple. However, if needed, the landfill side of the model could be fully expanded using established modeling tools that account for context-dependent factors such as organic content of the solid waste, age of the landfill, and climate. Landfill break-even electricity production costs. Acknowledging the sensitivity of Bitcoin mining's financial outcomes to electricity pricing, our analysis spans a range of feasible break-even electricity production costs for LFGTE projects. Tedeschi and Lee recently estimated the cost of electricity production from landfills to range from 3 cents to 10 cents per kilowatt hour. A synthesis of a 2018 USA data found a levelized cost range of 5 cents to 6.8 cents per kilowatt hour for fully capitalized LFG electricity production. The LMOP manual suggested that LFG electricity costs range from 2.5 cents to 11 cents per kilowatt hour and recommends a default assumption of 6.5 cents per kilowatt hour. Internationally, a variety of LFGTE electricity production costs have been reported. 8 cents per kilowatt hour at the Batten landfill in Jakarta, 4 cents per kilowatt hour in Delhi, and a levelized cost of 14.02 cents to 22.6 cents per kilowatt hour in Beijing. Based on the experience of our industry co-authors, we anticipate average cost of production for a low-flow landfill in the USA would be in the 5.5 cent kilowatt hour range. This information suggests that our choice for drawing samples from within the 1 cent to 10 cent per kilowatt hour range is credible for our model. At the low-cost end of the spectrum, the model was fixed at a minimum cost of 1 cent per kilowatt hour. At the high-cost end, the production cost options range from 7 cents to 10 cents per kilowatt hour in 1 cent increments. For the base case outlined below, we used low and high prices of 1 cent and 10 cent respectively and created a normal distribution of break-even prices to sample from with the mean, truncated at the low and high break-even prices. The standard deviation was set as the low plus high feasible break-even cost divided by 5. The range of plausible electricity production costs, in line with our own experience and available estimates in the literature, frame the economic landscape for LFGTE-derived electricity and aid in exploring the financial dynamics underpinning partnerships between landfill operators and Bitcoin miners. An important challenge for modeling integrated Bitcoin mining at landfills is that business structure has an important impact on revenue sharing and financial performance for both the miner and landfill operator. These have important implications for the likelihood of speed and scaling of development. The gross revenue share for landfill operators is typically within the 5% to 30% range for North American low-flow landfills. The landfill operators at these facilities would not typically produce any electricity, and the Bitcoin miners would supply all capital and variable costs for generating electricity. For this model, we assume that landfills with higher potential for generating low-cost electricity would tend to be more highly compensated via increased levels of revenue sharing. For each sample, we drew randomly across a uniform distribution range to calculate the revenue share for landfill operators. We calculated the miner revenue shares accordingly. Note that this revenue sharing arrangement could be easily structured to reflect more complicated situations such as, for instance, larger landfills that already have internal capacity to generate and sell surplus electricity to local electricity grids or industrial customers. Bitcoin mining operation. Using the available electricity supply earmarked for Bitcoin mining, we evaluated the number of high-performance ASIC mining rigs that would be needed to run the operation at full capacity. We considered 3 popular models, Bitmain's Antminer S19J XP, and both the air and liquid-cooled versions of the Antminer S21. The selection reflects variations in hash rate, power consumption, and pricing as detailed in Table 1. An electricity supply of 10 million kilowatt hours per year allows for the deployment of 352 S19J XPs, 326 S21s, or 213 S21 hydro rigs. Commercially available 20-foot containers modified for Bitcoin mining and with 1,440 kilowatt per hour power input capacity each can handle up to 288 computers, allowing S21 hydro rigs to be deployed with minimal footprint and ancillary equipment requirements. The S19 XP and S21 air-cooled models would require a 40-foot container for full deployment. An analysis of older Bitmain S17 computers provides insight on container deployment costs and mining profitability on solar farms where levelized cost of electricity was in the 1.9 cent to 5.1 cent range for commercial container setups. Mining financial assumptions. Pool fees were set at 2% and were deducted from the hash revenue split for each party. We assume that miners paid for all additional capital and operating expenses. An influence diagram delineates the interconnected financial variables, including hash price dynamics, influenced by market conditions, and operational decisions regarding electricity pricing and revenue sharing. We assume that non-electricity operating expenditures were 15% of electricity expenditures for all models of mining rig. Often, operating costs will fall below that level because variable costs associated with electricity generation can also cover mining facility operation costs. We focus on changes in revenue for both miners and landfill operators. Given the rapidly changing pricing for rigs, advancing energy efficiency, and miners' propensity to switch rigs on and off as Bitcoin price fluctuates, analyzing longer-term financial performance would add more uncertainty into the model. Hash price is a function of 5 factors. The block reward, 3.125 Bitcoin per block from mid-April 2024 to approximately April 2028. Average transaction fees per block, total network hash rate, the difficulty adjustment, which is modified every 2 weeks to maintain block creation time of about 10 minutes, and the USD price of Bitcoin. The model offers options of 7.5 cents and 1.5 cents terahash per day for mean hash price. We then applied a log normal distribution transformation to mean to approximately a price distribution with an extended upper tail. Bitcoin is a financial asset with a very strong positive skewness, making it very unlike most financial assets where price risk is more to the downside. For the baseline model, we used a mean hash price of 7.5 cents per terahash per day, which resulted in the hash price distribution shown in Figure 5. Hash price reached as high as 40 cents per terahash per day during the 2020-21 bull run, but the drastic expansion of the global computational power in preparation for the April 2024 halving kept hash price relatively subdued over 2023 and early 2024. Counterbalancing the downward pressure of increased global Bitcoin network compute is the increase in transaction fees stimulated by the development of the ordinals marketplace in 2023 to 2024. Increased institutional demand in 2024 and beyond may also cause upward price pressure given Bitcoin's inelastic 21 million supply cap. All of these exogenous factors relating to the price uncertainty and global network growth pose significant challenges for Bitcoin miners' business planning, thus justifying a wide range of plausible prices from which to draw samples. Annual hash revenue is shared between the landfill operator and Bitcoin miner. The annual electricity cost for miners was a function of the break-even cost of producing electricity and the annual power consumption of the fleet of mining rigs. Other revenues costs were calculated stepwise with uncertainty from chance variables propagating through the financial performance metrics. Table 2 provides a summary of the model parameters we used. We also calculated the value of methane mitigation for a landfill capable of generating 10 million kilowatt hour per year, 1.14 megawatt, of electricity. A landfill of that scale would, assuming no parasitic electricity use for landfill operations, 30% power conversion efficiency for LFG to electricity, and an energy content of 10 kilowatt hours per cubic meter of methane, produce a total of 6.67 million cubic meters of LFG each year, 50% of which would be methane. Further, assuming that the landfill was undeveloped, with 100% venting prior to development and methane density of 0.656 kilograms per cubic meter, this implies that 2,187 metric ton of CH4 would be released into the atmosphere annually from the untreated landfill. Given the very distinct temporal patterns of methane emission from landfills, a function of landfill age, the organic content of waste, and other factors, our estimate should be regarded only as an approximation. Emission schedules can be developed following established landfill emission modeling protocols. The US EPA has recently revised estimates of social cost of carbon, and for the first time directly published values for the social cost of methane. SCC is a function of damage functions, time horizon, and discount rate. In the past, many government projects simply adopted an SCC value of $20 per metric ton of CO2 abatement. Although many environmental economists argued for values of $200 or more based on differing opinions about the proper choice of damage function and discount rates. The EPA report included a comprehensive review of SCC assumptions and a formal external review process suggesting SCCH4 values of between $1,300 and $8,200 per metric ton in 2020 dollars. Given methane's high impact within 30 years, we use the $4,002 per metric ton figure, which adopts a 2% discount rate and a time horizon out to 2050. We also assume that the mining rigs would be powered by grid electricity in the absence of LFG-based electricity. Note, however, that this would be unlikely, such as a mining facility in reality is mobile and could locate anywhere with lower cost power. We used an estimate of an average carbon intensity of 0.5 grams per kilowatt hour for grid-sourced electricity. Grid intensity is uncertain due to many factors influencing it, So our net benefit estimate should be taken as provisional and only applicable for currently undeveloped landfills. 4. Results. In this section, we present the outcomes of our Monte Carlo simulation analyzing the financial impact of integrating LFGTE projects with Bitcoin mining operations. Our findings highlight the potential revenue streams for Bitcoin mining under varying operational and economic conditions. Key results include the comparative revenue performance of different mining rigs, the financial risk and benefit for landfill operators and Bitcoin miners, and the significant potential for CO2e reduction through the proposed integration. These insights are crucial for stakeholders considering the feasibility and impact of leveraging LFGTE for cryptocurrency mining. Revenue from Bitcoin mining. The annual hash revenue is a function of rig hash power, efficiency, and size of the fleet deployed to utilize the full 10 million kilowatt-hour electricity supply dedicated to mining. Deploying fleets of 326 or 213 more energy-efficient S21 air or liquid-cooled rigs, respectively, relative to a fleet of 352 less energy-efficient S19J XPs, increases the likelihood of higher site revenue, pushing the probability density curve outwards. Recall the total revenue was then split between Bitcoin miner and landfill operator. For our baseline model, we present summary statistics in Table 3. For our initial review of model performance, we focus only on a fleet comprised entirely of air-cooled S21 rigs, the 326 computers, fully consume the 10 million kilowatt hour per year of electricity available. In our baseline model, the Bitcoin miner's net revenue probability distributions show that there are substantial financial risks for the Bitcoin miner. Recall also that this is a revenue figure and does not account for capital expenditures for rigs and supporting infrastructure. Combined, the revenue for both the landfill operator and Bitcoin miner combined shows positive upside, but the venture is not without financial risk. Even before considering depreciation, which would be approximately in the $350,000 a year range for the mine deployment. Factors influencing financial success. In the baseline model, we used random distribution across the full range of plausible parameters, but miners might be very unlikely to undertake Bitcoin mining under some of those combinations in the real world. For instance, it is very unlikely that commercial miners, given their sensitivity to electricity prices, would be willing to agree to a 30% revenue share agreement for an LFGTE project that could, at best, produce electricity at 10 cents per kilowatt hour. That would especially be the case if industrial electricity rates from the local grid were only 6 cents per kilowatt hour, or if extended bear market conditions and low hash price was expected over the next 2 years. To examine how the financial metrics responded to changes in our parameterizations, we ran additional simulations with different electricity prices and hash price, alone and combined. To illustrate the breadth of possible outcomes, we report below on alternative scenarios considering all three types of mining rigs with 27.3% lower landfill electricity generation costs, 100% higher hash price, and a combination of both. Figure 10 shows the net revenue for Bitcoin miners with both a low electricity price and high hash price. Note that the risk of operation losses from mining are now close to zero. The performance gap between relatively inefficient S19J XP rigs and more efficient S21S has widened, and that there is a long upper tail of the distribution that extends beyond the chart to greater than $15 million per year. Even allowing for depreciation expenses of $350,000 annually for the mining fleet, mining would typically be highly profitable. Emissions mitigation. Based on our use of $4,200 per metric ton for SC-CH4, there would be a gross emission reduction of 2,187 metric ton CH4 worth $9.18 million. Based on a grid carbon intensity of 0.5 kilograms per kilowatt hour and SEC value of $310 per metric ton, using electricity from the grid to power Bitcoin mining operations rather than LFG generated electricity, would incur a $1.55 million SEC. The net benefit would thus be $7.63 million. The 2023 EPA numbers are higher than the SEC of $50 per metric ton value under the Obama administration, and in stark contrast to the $1 to $7 per metric ton figure under the Trump administration, a difference due to the use of higher discount rates. In addition, the SEC values are higher than market prices for carbon credits, so individual facilities would need to assess any revenue streams accruing from methane mitigation in accordance with their development status, regulatory environment, and access to mitigation compensation mechanisms. 5. Discussion. In this study, we present a novel model assessing Bitcoin mining's role in mitigating and monetizing methane emissions from LFGTE projects. Centered on the cost dynamics of electricity production from captured LFG, this model highlights the potential economic and environmental benefits of integrating Bitcoin mining with methane mitigation efforts at solid waste disposal sites not yet fully utilizing methane capture. This integration not only proposes a method to enhance landfill sustainability, but also introduces a potential economic boost for landfill operations currently venting or flaring methane, offering them an alternative revenue source through the global Bitcoin market. Such an approach is particularly pertinent in regions where legal mandates require gas flaring, suggesting that Bitcoin mining could improve the financial feasibility, potentially accelerating the development of landfill gas capture infrastructure and reducing the tax burden on local residents and businesses. However, the model also highlights significant financial risks, particularly for smaller landfills that may have high per kilowatt-hour electricity production costs, or in situations where the hash price of mining were to fall even further from its 2022 to 2024 bear market range. The model highlights the importance of strategic decisions in hardware selection, operational efficiency, and revenue sharing models to balance benefits and risks for both landfill operators and Bitcoin miners. Study limitations and future research. Our model simplifies complex phenomena to make the integration of Bitcoin mining with LFGTE projects analytically tractable. The global Bitcoin network hash rate and the market price of Bitcoin, both pivotal to the model's economic projections, highlight the importance of understanding risk tolerance in the face of financial uncertainties inherent in mining and landfill operations. These factors are notoriously hard to predict. As such, our results should not be viewed so much as a predictive model of what financial status will be in the future. Rather, this type of modeling, where variables with a high level of uncertainty are recognized as such, give miners and landfill operators an idea of what they need to believe about exogenous factors affecting hash price in order to proceed with mining. This approach is characteristic of models dealing with deep uncertainty and pragmatist in nature. Understanding one's own belief about exogenous events and risk tolerance are important considerations when the range of financial outcomes is so wide. The model's current parameterizations, reflecting typical North American landfill conditions, may not directly apply to varied geographic and operational contexts, particularly in developing countries with different climate, waste composition, and management practices. Despite this, its flexible design allows for recalibration to diverse scenarios, indicating broad applicability with potential adjustments for local specifics. Limitations also stem from simplified assumptions about revenue sharing and electricity costs, which lack the complexity of real-world PPAs and negotiated revenue sharing arrangements. Such agreements, influenced by regulatory, market, and strategic factors, suggest our model's financial flow and risk distribution may not capture the full nuance of actual implementations. Our assumptions that the Bitcoin miners pay all capital and operational costs, taking on all risks, may not be appropriate for larger landfills that already have the capacity and management expertise to produce biofuel and generate electricity. In such cases, revenue sharing agreements may need to reward risk-taking landfill operators with higher Bitcoin revenue shares. In some cases, it may even be the case that landfill operators take full responsibility for mining and simply contract for Bitcoin-oriented technical services such as rig repairs. Future research should address these limitations by examining the impact of technological advancements in Bitcoin mining and changes in regulatory frameworks on the integration's viability. Innovations in mining hardware, shifts in energy policy, and new incentives for renewable energy could significantly affect the model's assumptions and outcomes. Enhancing our model to reflect these dynamic factors will deepen our understanding of how digital financial technologies intersect with renewable energy projects, providing insights into effective strategies for leveraging Bitcoin mining in methane mitigation efforts. Determinants of financial viability. The model clearly demonstrates the lower electricity prices achievable through efficient LFGTE operations significantly enhance the financial outlook for Bitcoin miners by reducing the risk of operational losses. For instance, simulations within our study showed a direct correlation between electricity cost reductions and profitability improvements for mining operations. This trend underscores the necessity for securing competitive energy sources as a cornerstone for sustainable mining practices. Conversely, the model revealed stark variabilities in financial performance, with net revenues for miners ranging from as low as $442,606 to as high as $15,479,532 annually, depending on revenue sharing and electricity production costs. For smaller landfills, the model suggests that leveraging low electricity costs and exploring diversified revenue streams may be essential strategies to attract commercial mining partners. This could involve innovative business models and revenue sharing agreements tailored to align stakeholder interests, thereby fostering mutually beneficial partnerships. These strategies not only aim to align stakeholder interests, but also to capitalize on the unique opportunities presented by the Bitcoin mining market. Moreover, hash price fluctuations emerge as a significant determinant of financial outcomes, with scenarios of increased hash price, either alone or in conjunction with low electricity costs, substantially boosting revenue potential. This finding points to the decisive impact of Bitcoin's market conditions on the economic feasibility of integrating mining with LFGTE projects. The pronounced variability in hash price, a primary driver of profitability variations, underscores the critical need for business models that are both adaptive and flexible, capable of navigating the Bitcoin mining sector's volatile economic landscape. Technological advancements and energy efficiency in mining hardware. Our analysis reveals that selecting modern, energy-efficient mining rigs significantly improves the financial outlook for integrating Bitcoin mining with LFGTE projects. These advanced rigs not only enhance the potential for higher gross profit, but also act as a critical buffer against financial losses. Specifically, simulations from our study demonstrate that energy-efficient technology expands the probability distributions of financial outcomes, increasing the likelihood of positive performance. Such findings underscore the importance of hardware efficiency in mitigating the risks associated with the volatile nature of Bitcoin mining and fluctuating energy costs. Adopting more efficient hardware shifts the economic equation of landfill mining integrations towards greater resilience against market fluctuations. As a result, the scalability of mining operations, underpinned by technological progress and the strategic deployment of efficient hardware, becomes essential. This shift demands a reassessment of financial models to accurately reflect the interplay between energy efficiency, operational costs, and market-driven revenue potentials. Future research might delve into the scalability of Bitcoin mining concerning energy availability and technological advancements. Investigating the impact of the latest mining rigs on optimizing energy consumption and financial outcomes, especially within diverse regulatory frameworks, is crucial. Anticipated regulatory changes aiming to foster renewable energy use and efficiency in Bitcoin mining will likely influence the economic feasibility of these integrations. The value of methane mitigation. Incorporating the unique capacity of Bitcoin mining to utilize electricity generated from LFGTE projects presents a substantial opportunity for CO2e reduction, demonstrating a significant dual benefit for both environmental sustainability and economic viability. Our model's findings illustrate how a relatively small landfill could mitigate 2,187 metric ton of methane, underscore the importance of integrating Bitcoin mining with LFGTE processes. That highlights a method that not only aids in the direct mitigation of climate change through the reduction of methane emissions, but also elevates LFGTE projects to a pivotal role in the generation of considerable environmental credits. The strategic integration of Bitcoin mining with methane mitigation efforts transforms an environmental challenge into a viable economic asset. This is highlighted by the model's estimation that a gross value of methane reduction from an undeveloped landfill could reach approximately $9.18 million based on current EPA valuations of methane social cost, pricing SCCH4 at $4,200 per metric ton, assuming a 2050 time horizon and a 2% discount rate. The pursuit of carbon credits offers a financial incentive primarily for landfills yet to maximize methane destruction or monetize emissions reductions, specifically those venting significant methane. Installing gas collection and control systems becomes an additional but critical investment, facilitating methane capture for power generation and Bitcoin mining. The complexity of royalty-based contracts for landfill gas is notable, encompassing all revenues generated by the LFGTE developer, including carbon credits and other environmental attributes. Such arrangements offer flexibility to customize agreements concerning carbon credits, thus mitigating payback risks associated with GCCS investments, particularly given the landfill's compliance obligations for methane collection and destruction. Revenue from carbon credits, beyond the share allocated to landfill, is typically divided between the Bitcoin mining operation and the infrastructure financing provider. During the refinancing period of the infrastructure loan, the majority of carbon credit revenue tends to favor the financing provider. Subsequently, the lion's share of this revenue shifts to the Bitcoin mining company, reflecting a structured transition in revenue allocation over time. The role of independent specialists in the measurement, reporting, and verification of carbon credits is crucial. These specialists are compensated based on the volume of carbon credits generated, emphasizing the importance of accurate and reliable verification processes in the monetization of methane mitigation efforts. Scalability and global methane mitigation initiatives. The integration of LFGTE operations with Bitcoin mining may hold transformative potential for environmental management and energy production on a global scale. The scalability of such initiatives closely links the dynamics of the global Bitcoin market and the availability of low-cost waste and renewable energy sources. In the USA alone, there were some 62 underdeveloped low-flow solid waste disposal sites and a total of 463 LMOP candidate sites with 965 megawatt capacity in aggregate and 53 million metric ton per year CO2e abatement potential. A total of 532 projects with 1,287 megawatt capacity are already active and actively mitigating methane emissions. While Bitcoin mining at already developed landfills may not accrue any benefits in terms of net mitigation, improving the economics of LFGTE operations may bolster the long-term sustainability of facilities and reduce waste disposal costs or taxation rates for local citizens and businesses. The economic feasibility of integrating LFGTE with Bitcoin mining in developed countries, however, faces challenges from alternative low-cost renewable energy sources and stringent regulatory frameworks. The effectiveness of market signals to incentivize such integration significantly depends on the global Bitcoin market's evolution and available energy sources. For instance, mining at small LFGTE operations in countries with robust regulations may not be economically viable if miners have access to other low-cost energy sources. Nevertheless, LFGTE operations could significantly benefit from improved cost recovery while aligning with regulatory standards. Expanding mitigation options and broadening geographic scope beyond current carbon mitigation agreement signatories is crucial. Global landfills emit significant methane from approximately 2 billion metric ton of solid waste generated annually, a figure projected to increase by 70% by 2050. Sanois et al. Estimated that annual methane emissions specifically from waste disposal, landfills and wastewater treatments, were in the order of 65 million metric ton, accounting for about 12% of global anthropogenic emissions. National emissions from landfills in China and India were estimated at 1.86 million metric ton and 1.08 million metric ton, respectively. In Africa, where urban areas produce approximately 244 million metric ton of waste annually, the potential for energy recovery and electricity generation is vast, yet often hindered by economic and management challenges. If this resource could be tapped, it would theoretically be possible to recover as much as 363 petajoule of energy and generate 122.2 terawatt-hour of electricity annually. For context, the global Bitcoin network, currently 24 February 2024, has an annualized electricity consumption of 165.7 terawatt-hours. Nisbet et al. Note that in many tropical nations, landfill methane emissions are wholly uncontrolled and are characteristically high, and that there is often little interest in investment in methane emission control, and there is poor management of emissions in many cases. Small-scale biogas electricity in Africa, for example, has been economically marginal, often relying on subsidies or feed-in tariff rates of 20 cents per kilowatt hour to maintain operation. In Germany, feed-in tariff rates were as high as 27 cents per kilowatt hour to encourage energy production from farm manure management. Increasing the financial return for waste collection, management, and LFG production may be a game changer for waste management facilities in the developing world. Introducing Bitcoin mining as a viable energy consumer near underutilized low-cost energy sources could offer significant benefits, including local community electrification through excess energy distribution, a phenomenon already observed in Africa. Application of this modeling approach in other sectors. Our study, while focusing on LFGTE projects, lay the groundwork for a modeling approach with wide applicability in sectors grappling with methane emissions. Notably, agriculture, food processing, and urban wastewater treatment emerge as key areas where Bitcoin mining could play a transformative role. Methane emissions from livestock farming is a major source of methane emissions, largely due to enteric fermentation in ruminants and manure management practices. For example, farm manure has the potential to supply about 1% of the U.S.'s annual energy consumption. With electricity production costs in the food sector ranging from 5 cents to 12 cents per kilowatt hour, integrating Bitcoin mining could offer a viable path to monetizing energy otherwise lost to emissions. In India's Haryana state alone, Dung production could generate 9.84 terawatt hours annually, roughly 6% of the current Bitcoin's network global power needs, showcasing the sector's potential contribution to sustainable energy production and emission reduction. Urban wastewater treatment facilities, through anaerobic digestion of sewage sludge, also stand as significant methane emitters. However, these facilities typically have mechanisms for biogas capture and use, mainly for heating or electricity generation. By incorporating Bitcoin mining, such plants could significantly lower their net operational costs, given that urban WWTPs often have more diverse options for biogas and electricity sales than rural landfills. The introduction of Bitcoin mining needs to be evaluated against potential opportunity cost to determine its financial and environmental return on investment. The question becomes one of determining under which circumstances Bitcoin mining offers a higher return on investment than other revenue sources, and how much improved WWTP cost recovery could contribute to mitigation performance and financing requirements, i.e. taxation or disposal fees for citizen and industrial waste producers over time. Similarly, vented methane from oil and gas production presents an untapped resource for Bitcoin mining. Integrating mining operations with methane capture initiatives in this sector could not only provide a new revenue stream, but also aid in significantly reducing greenhouse gas emissions. The broad potential of our model to assess Bitcoin mining integrations across these sectors highlights its capacity to identify opportunities to leverage Bitcoin mining's economic incentives for enhanced methane capture and utilization. Stakeholders in agriculture, food processing, wastewater treatment, and the oil and gas industry could thus be incentivized toward more aggressive methane mitigation strategies. Tailoring this model to the unique operational and economic context of these sectors could help balance environmental sustainability and financial viability. 6. Conclusions. This study highlights the transformative potential of Bitcoin mining to convert waste gas from LFGTE projects into a valuable resource, signifying a departure from traditional, regulation-driven environmental mitigation strategies towards innovative, financially incentivized efforts. By leveraging Bitcoin's economic incentives, our model proposes a strategic method to expedite methane mitigation efforts, bolster the economic appeal of these initiatives, and potentially alleviate the tax burden associated with regulatory compliance. This approach not only challenges conventional strategies, but also introduces a scalable and universally applicable solution for methane reduction that minimizes reliance on government subsidies or infrastructure spending. No single strategy suffices for landfill methane reduction, a complexity mirrored across agriculture and energy sectors. Success in achieving global methane mitigation targets relies on deploying existing technologies while fostering innovative solutions and supportive policies. Our model underlines the necessity of plausible assumptions about Bitcoin hash price and electricity generation potential to assess the viability of Bitcoin mining as a mitigation strategy, prompting the question, what do we need to believe about Bitcoin's hash price and landfill electricity generation potential to make Bitcoin mining a sensible mitigation option? Key factors such as energy generation potential, alternatives for biofuels and electricity markets, capital expenditures, technical expertise, carbon credit availability, and risk tolerance are crucial for landfill operators and Bitcoin miners. These elements not only determine the feasibility of Bitcoin mining for each landfill, but also guide the development of appropriate business models for LFGTE mining partnerships, particularly regarding local level control over electricity costs. In cases where low-flow landfills may not be able to reduce electricity costs to such a level that commercial Bitcoin mining is viable, those partnerships may need to take on forms more appropriate for cost recovery of mitigation expenditures. Merging renewable energy projects with Bitcoin mining suggests a novel and pragmatic pathway for accelerating infrastructure development and simplifying regulatory compliance, offering fresh perspectives on sustainable energy. This market-oriented, incentive-driven strategy underscores the potential for Bitcoin mining to scale methane mitigation efforts effectively. It also hints at its wider applicability in sectors grappling with similar challenges. Future research should not only refine and build upon these preliminary insights, but also urgently explore Bitcoin mining's full potential in promoting environmental sustainability.